All right, bull runners, welcome back to the channel. So let's dive right in and let's talk about the expectations over the next few months, because October, the Fed is likely to cut. December, the Fed's likely to cut. January, they're likely to cut. And in Jerome Powell's speech, this image was posted right here about the expectations for rate cuts. And each dot represents what one Fed official thinks the midpoint of the target range should be by the end of the year and into next year, going into 2027. So the Fed is going to keep cutting rates going into 2027, which theoretically should be bullish for the market. But is that the case? Well, let's discuss it, because the Fed has a dual mandate to keep inflation low and employment high, whereas inflation has been going up since April. And so with them expecting to lower rates, they're caught in a pickle, like I always say here, where I'm actually expecting inflation to go up, very similar to what happened here after February of 2021 until June of 2022. Because if you look right here on the effective federal funds rate in February, the rates were at 0.08%, and they stayed low around that exact same level until a year later of February of 2022. But by then, inflation had already climbed up to 7.9%, and they were too late. So as Donald Trump has said, too late, Powell always raises rates or cuts rates too late, and they're doing the same thing again. So inflation has been low around their 2% target for the past year now, and now they're deciding to cut rates. Now the problem is inflation's been ticking up. So with them cutting rates, it's more likely that inflation goes up rather than going down. And the reason why is really simple. Rate cuts lower borrowing costs, encouraging spending and investing, which boosts demand. So increased demand can outpace supply, pushing prices up and raising inflation. And regardless of whether inflation goes up closer to 4, 5, 6, 7, 8, 9, 10% or not, regardless, if you look at the inflation calculator with US CPI data over the years, well, in January 2024, $1,000 would take $1,030 now to buy the same item. And if you expand that out even longer, over the course of 25 years from the year 2000 to January of this year, you would have lost 88% of your spending power, and it would take nearly a 2x to buy the same items today as it would back in the year 2000. So for the 20-year-olds out there, or 30-year-olds, or even 40-year-olds who don't own a home yet, over the next 10 to 20 years, it's about to get even worse, because the US national debt has ballooned so much to the point where it's created such a big gap between the federal spending and the tax revenue to create a budget deficit of nearly $2 trillion. Now, the real issue is not just the deficit or the spending here and the money printing. It's the interest the government has to pay on that debt. And as inflation continues to rise, but minimum wage hasn't changed in over 15 years, then it's very difficult for the everyday American to get ahead unless they become investors or they start their own business. Because if you look at this chart right here showing the difference between real and nominal value of the federal minimum wage in the United States from 1938 to 2024, you can see that the unadjusted wage, which is real US dollars at face value, is $7.25, whereas the inflation adjusted wage is the exact same. Now, here's the issue with this. If we look back at 1970 at the peak here in terms of inflation adjusted wage in nominal US dollars at $13.05 versus the unadjusted wage, which is real US dollars, which was $1.60 for minimum wage in the 70s. So this means that $1.60 in 1970s translates to about $13.05 in 2024 dollars, creating a massive gap. And that's over the course of 54 years, which is built up from compounding inflation here. And because there's been no federal increase in minimum wage since 2009, it means that the $7.50 nominal wage has stagnated while inflation has chipped away at its real value. And you might think this doesn't apply to you if you make more than minimum wage, but this actually applies to you more than ever before if you're just saving your money in a bank account, hoping to just save for retirement, buy a house, and then retire into the sunset with your white picket fence. Because if you look at the purchasing power of the dollar over the years, ever since the dollar was taken off the gold standard in 1971, and quantitative easing was put on basically steroids with George Bush in order to stimulate the economy after the 2008 subprime mortgage crash, well, the US money supply has since grown by $3.8 trillion just in 2020 alone over the course of the few months after COVID, equal to 20% of all the dollars ever created. There was more money put into circulation in like 3 months than the first 200 years of the United States being formed after the COVID crisis. You know Gary Gensler. One of the best days in crypto history was when he stepped down, and now he's been on the hot seat here on CNBC. Listen to what they just said here.
They are reversing a lot of what you did. And how are you feeling about what they're doing now?
So I'm very proud of what we accomplished.
And the crypto community is ecstatic not to have you there anymore and to have him there. Looking back on it, I mean, do you think that was the right call?
Yes. I think
Because look, now we have this like burgeoning industry, and there's so much more innovation and leadership in the U.S.
and a
around
lot more
crypto.
capital coming into it.
there may be more capital in terms of the interest in the public. The public is interested. I get that. But for investors,
You think this is dangerous, what they're doing?
put aside Bitcoin, but most of the other tokens are not tied to any fundamentals. Like Warren Buffett would say, what are the goods? What are the revenues? What are they selling? And so forth.
So this is just the highest level of delusion where he thought his moves were the best moves, and clearly they weren't, because they just stifled innovation. And now we can see the light at the end of the tunnel here with these ETFs getting ready to be approved. And so the SEC has from October 18th through the 25th to basically approve or deny the XRP ETFs from Grayscale, 21 Shares, Bitwise, Canary Capital, Wisdom Tree, Franklin Templeton, CoinShares. The only company that's really missing on this list is BlackRock, and they're keeping it on the hush-hush right now because of the non-disclosure agreements that are signed between Ripple and BlackRock. Now, again, the Treasury has been buying back debt. You can see here, September 18th through September 19th today. On the Treasury buyback operation, the results here shows the maximum par amount to be redeemed, total par amount offered, total par amount accepted in the billions of dollars. So basically you're buying your debt with more debt here, and this further pushes up the costs of things like stocks, real estate, precious metals, even crypto. And if you look at buying versus renting in America here, with home prices and mortgage rates both rising, the US has witnessed the biggest numerical gap in cost between owning a home and renting in over 50 years. So Americans, however, have seen similar scenarios since the 1980s. During the peak of home buying for the older baby boomers, the 30-year fixed mortgage rate hit a record high of 18.63% in October 1981. Then we saw this blue line right here, which is the cost to buy, come closer to the red line, the cost to rent. And it was really just a toss-up on what you wanted to do. Obviously, buying a home during that time made more sense if you were going to own the home over the course of decades, but if you were just going to be in it for a year or two, it just made more sense to rent. Then the housing bubble by 2006 to 2008, the gap was so massive between the cost to rent versus the cost to own that the smartest move during that time was to just wait and then accumulate when this blue line right here dipped below the red line, the cost to rent. So then you could buy up the homes on a dip and rotate your capital into real estate. Then you would have ridden that wave back up to where we're at today. And if you look at this, the gap is the largest that it has ever been, where it just makes more sense for people to rent than it does to own these days, especially since after February of 2022, since the Fed jacked up interest rates. They're still up here where it made more sense to buy a home in 2022 or earlier. So a lot of people that are being sold on the dream of save in a high interest savings account, well, their dollar's getting eroded because the US national debt continues to climb. And the gap between owning a home versus renting a home is so massive right now that if you look at the median sale prices of houses sold in the United States, well, in quarter four of 2022, it was at the peak. And so we've been slowly going down from here. So based on this chart alone, it reminds me of what happened here going from 2007 to 2009, leading us into a recession. It's just not smart to buy a home right now until this bottoms out. And this has happened several times in the past where it leads us into a recession, and then you could buy homes at a better price after the Fed has cut rates. So with projections going into 2027 of rates going down, a lot of people are going to be looking to refinance their home, and a lot of millennials are going to be looking to buy a home, but I don't think that time is now. Because if we look at the M2 money supply, it's at an all-time high. Trillions of liquidity are flowing into the system, and we're seeing that reflect in the stock market. The S&P 500 is at an all-time high. Even looking at the price of gold here, gold's pretty much at its all-time highs. And if you look at silver, silver's just lagging behind gold. It's still below its all-time highs, but I think silver's going to break out into price discovery and go into it a massive euphoric run. And then that brings me to the crypto market, because Bitcoin right here is just teetering right below its all-time high. And I think we will see a blow off top for the crypto market. Now, if you look at this right here, FTX, the cryptocurrency exchange that collapsed during the bear market, well, they're set to distribute $1.6 billion to creditors on September 30th by the end of the month. So more liquidity is going to be coming into the market, and there's multiple catalysts that are lining up for an incredible Q4. The Russell 2000 just hit a new all-time high. And if you look at the Russell 2000 compared to the crypto total market cap excluding the top 10, well, the Russell first broke out right here in November of 2020, made a new all-time high, and proceeded to rally up till the 15th of March. And then others shortly after that, on the 28th of December, broke out to an all-time high with the Russell 2000. So right now, the Russell 2000 made barely just an all-time high, very similar to what happened back here by November of 2020. And if you look at the others chart right here, it's still below its all-time high. So if the Russell 2000 does a similar run to what happened right here between November 2020 to March of 2021, then I would expect that to flow into the altcoin market as investors rotate their fiat currencies, their US dollars, over into crypto.